A bond is essentially a loan you give to a corporation or government. In return, they promise to pay you back with interest over time. Bonds are a fundamental component of the financial world, providing a way for organizations to raise funds for various purposes. Let's break it down in more detail. Types of bonds. Treasury bonds are issued by the U.S. government and are considered some of the safest investments available. These bonds come in various lengths, from short-term bills to long-term bonds, and are backed by the full faith and credit of the U.S. government. Investors often turn to Treasury bonds during times of economic uncertainty for their stability. Municipal bonds, or munis, are issued by local governments to fund public projects like schools, highways, and other infrastructure. One of the biggest advantages of municipal bonds is that the interest you earn is usually tax-free, which can make them an attractive option for investors in higher tax brackets. Corporate bonds are issued by companies to raise money for various business activities such as expanding operations, funding research, or paying off existing debt. While they typically offer higher returns compared to government bonds, they also come with more risk, as the company's ability to repay the bond depends on its financial health. How bonds work. When you buy a bond, you're essentially lending money to the issuer. In return, you receive regular interest payments, known as coupon payments, and your principal back at maturity. Let's take an example. If you buy a $1,000 bond with a 5% annual interest rate, you'll receive $50 a year until the bond matures. Why invest in bonds? Bonds provide regular interest payments, making them a reliable source of income, especially for retirees or those looking to supplement their income. This steady income can be particularly appealing during periods of market volatility when stock dividends may be less predictable. Adding bonds to your investment mix can help reduce overall risk. Bonds often have an inverse relationship with stocks. When stock prices fall, bond prices may rise, helping to balance your portfolio. Diversification through bonds can provide a cushion against market downturns. Risks of bond investing. When interest rates rise, bond prices fall, and vice versa. This happens because new bonds are issued with higher yields, making existing bonds with lower rates less attractive. Investors need to be aware of interest rate movements and their potential impact on bond prices. Credit risk is the risk that the issuer might default on their payments. This risk is higher with corporate bonds, especially those issued by companies with lower credit ratings. Investors should consider bond ratings provided by agencies like Standard & Poor's and Moody's to assess the risk level. Fixed interest payments might not keep up with inflation, reducing your purchasing power over time. This risk is particularly relevant in periods of high inflation, as the real value of the interest payments diminishes. Some bonds, like Treasury Inflation-Protected Securities, TIPS, are designed to mitigate this risk. Conclusion: bonds are a key part of a diversified portfolio. They offer steady income and lower risk compared to stocks. By understanding the different types of bonds and their associated risks, you can make smarter investment decisions. Remember, a well-rounded portfolio often includes a mix of both stocks and bonds.